Well, welcome everyone. Thank you for coming today. I'm Todd Fuller, President and CEO of EverBless Foundation. Good to see everyone here, a lot of familiar faces and some new faces. So everyone, welcome. Glad you could make it. This is our 2023 annual investment review. This is the 15th year that we have done this, counting the virtual years of COVID, but this is our second year back in face-to-face, and we're glad you all can make it. We'll hear from Becky and Jerry a little bit later. Jerry's claim to fame in life now is that he has been to all 15 of the EverBless Foundation meetings, so we're glad they can do that as well. So just to kick it off, a couple of things to touch on. Our board, very valuable. All of our board members, current board members are here. If you would just stand up or wave and let everyone recognize and see. We thank them all for being here. This is all our current board. And then Jolynn, John Hatfield, a couple of former board members here as well. Thank you all for coming. On this list here, we have our investment committee. Rick Glisson is the chair of our investment committee this year. Ben Silman is not on this list. This is last year's trustee list. Ben just joined us in December, and Ben is on our investment committee and is a trustee for 2024. Leah Hopper here. Leah is at Riverfront Investments here in town, and Greg Key here with us from Derbyshire Baptist. So we thank all of them for being here, and all of our other board members. A little bit about EverBless. 227 million in assets under management. 12 different Baptist associations, a lot of different Baptists. Virginia Baptist Partners, what are those? The different Lifespire, Hope Tree, the former retirement homes and children's homes are good partners of ours. Oak Hill Academy, Southwest Virginia Partnership, those types of things are in that group. And then over 300 different Virginia Baptist churches that are clients of ours. One of the most often questions I get when I go out is, what are other churches doing? How are they doing things? And as you all know, here we offer the three portfolios: the equity portfolio, most return, most potential for return, most volatile. Fixed income, least volatile, least return long term, and then a balanced as a combination. And you can see large percentage of our clientele is in the balanced portfolio, and then you can see the other different mixes just for information purposes. And I think, Becky, I've heard you say maybe last week in one of our presentations that last year balanced portfolio was kind of not kind of frowned upon, if you will, but it's come back, or the year before, and it's come back. It has come back. So, but this is what our mix is doing, and what our clients are doing, and always good to share that. And then our team, as you know, Jerry, as I mentioned, has been with us forever. And Jerry, the picture
that's 15 years old.
Yeah, that's a 15-year-old picture.
I'm not giving that picture up.
And then Becky is with us. Those of you who were last year, Becky was with us last year and presented for the first time last year. Becky is taking Carol Meiss's place. Carol had done it in years prior, virtually, and prior to that. And Carol retired. Her last day was, I think, January 10th, or just this past month. So happy for Carol, and happy to have Becky. So at this time, I'm going to turn it over to her. She's going to present, talk about 2023, 2024 a little bit, and then at the end, Brett, Jerry, and I will come up, take some questions, give you an update on the business update on the business side of Vanguard, where they are. You ready?
Yes, sir.
Thank you.
Maybe someday I'll make 15 investment reviews like Jerry. But thank you so much for having me back here today. I really excited to be here. So I thought maybe about breaking the presentation up into sort of 3 chunks. We'll take some time to review, what happened in 2023, how did various markets perform, and then look at sort of the current economic environment, what's at play, what's going on, and how does that impact then our forward outlook. So to get started, I was up here last year talking to you about 2022, which was abysmal from a performance perspective. So this shows, your U.S. equity market returns, fixed income returns, then that balanced portfolio that Todd was talking about, 60% equities, 40% fixed income, and then volatility over there, the kind of the magnitude and moves of the market performance. And these are the returns, and then how frequently over the history since 1928 has that occurred. So you see where the performance of 2022 kind of fell very to the negative side. What we saw in 2023 was above average returns for equities and fixed income, and also lower volatility. So, really strong returns for the year so far, or for the year 2023. I think this is interesting. This kind of breaks down the U.S. equity market, and on the right, the U.S. bond market, by kind of what occurred over the month. When we think back about all the things that happened over the course of the year, we had 4 Federal Reserve interest rate increases, we had the regional bank failures, we had the Israel-Hamas attacks, we had a kind of a debt government shutdown kind of looming that was averted, but there were lots of events that occurred over this course of time. But I think what's interesting is that really the vast majority of the equity market returns and really all of the fixed income returns occurred in the last 2 months of the year. What we saw was the Federal Reserve held interest rates steady again in their kind of October-November meeting, again in December. Interest rate or inflation forecasts started coming in lower, and there was a lot of enthusiasm that we'd done our job, and that the expectation was that the Fed was going to cut rates. They weren't going to need to go any higher. More interest cuts were expected in the market, so bond rates fell and prices went higher. Same thing happened in the equity markets. Equities rallied kind of around that news with expectations that things are getting better. And that really drove a lot of that market return over that period of time. This chart kind of breaks down, looks at equities, fixed income, and then the balanced portfolio. And so the dark blue bar is the most recent quarter, and then 1 year to date, same numbers. So we're kind of looking at the full 2023 on those other bars. So you see kind of in the dark blue bar, over the quarter, the rising tide kind of lifted all boats across kind of all asset classes and down to the balanced portfolio. Strong returns. So we'll really focus a little bit more on the full year on this slide. And I think what you notice is certainly that U.S. equities were, again, the clear winner as far as domestic versus international. And really marvelous returns for your balanced portfolio. Last year, both of those numbers were negative 16%. And to Todd's point about, it really didn't matter if you were in equities, fixed income, it was really, very negative, starkly negative returns across the board. But, really strong returns, equity and fixed income really helping out your balanced portfolio. This is looking at U.S. equities by size in those first 3 columns, and then by style, like value and growth, and then international markets, developed and emerging. And I think what this is really, you see very clearly here, is the outperformance in the U.S. large cap space, and particularly in the style of growth. And we'll disaggregate that a little bit later when we talk about what's underpinning these returns. The emerging markets was a laggard over the year. It was driven a lot by poor performance in China. It's a big part of the emerging markets index. Not all emerging markets perform poorly. We've seen Latin America and some areas of emerging Europe performing well, but emerging markets really held down some of that weakness in the property sector, consumer confidence in China. So that's kind of disaggregating the equity markets. And this is looking at fixed income. So those first 4 bars are kind of looking at the quality, starting with U.S. Treasuries and then moving down towards high yield, the more equity-like correlated part of the fixed income market. So you see returns in the high yield kind of performing more similarly to equities, higher returns there. And then when you think about maturity as the duration is a word that we use a lot in fixed income. That means your interest rate sensitivity. And the longer duration bonds, and long term, they have more interest rate sensitivity. So as we saw those interest rates fall, those longer, higher duration, longer term bonds, prices move very extreme, but they're also, it works the other way, and we saw this in 2022. That return was negative 29% for 2022. So we really see a lot of fluctuation. When interest rates are moving significantly, you get a lot more of that impact on the longer end. So that's driving a lot of the quarterly returns that you see in long-term treasuries there. So that's kind of a look back at what happened in the asset class. So these next couple slides have a lot to do with interest rates. That's really kind of the crux of a lot of what's going on right now is what's going to happen with interest rates. So I kind of look at that as sort of three components to that. Monetary policy is really tight right now. And that's to bring down inflation, but it also has the same impact of kind of constricting growth. And when you constrict growth, you typically raise unemployment. And the Fed has a dual mandate of price stability and maximum employment. So, where is that kind of right level, and what's the process to getting to the right level where they're not being stimulative or restrictive and kind of maximizing both of those? So, as policy becomes and continues to restrict the economy, where do we settle at? And then two, our expectation is that that equilibrium level is going to be higher than what we've experienced in the post-global financial crisis era. We've been in an environment of zero, negative interest rates, other places. And, that is incredibly low. So we do not expect that they're going to, go back down to zero. So we think that that kind of equilibrium level of interest rates is higher than what we've experienced over the past decade. And from our perspective, that is one of the most positive developments in the economy that we've seen over the past decade. It's what we call a return to sound money. When interest rates are zero and your opportunity cost for other investment is also kind of zero, you have a much more overspending, reaching for yield, speculation. So as interest rates settle higher, you are going to have that opportunity cost. I looked at the federal money market is yielding 5.27%. That's your opportunity cost of doing other things right now in this environment. Now that's not a durable yield, but that's your current yield on cash. So, we think that these higher level of interest rates are going to lead to a more judicious allocation of capital than we see when we have zero interest rates. So those are kind of three key components of the interest rate story that's really important right now. So this is looking at path of interest rates. We saw the Fed in 2022 raise interest rates 4.5%. 2023 raised them another %. And they, for the past 5 months of the year, they've kind of held steady. We kind of expect that to continue. We think that the Fed is likely done raising interest rates. The question, I think, is more in how long are they going to hold and when do they cut and how much. And the market tends to price all of that in. And we saw that happen this week. When the January CPI numbers came out ahead of what was expected, we saw the market kind of react in a way like, oh, maybe the Fed isn't going to cut as soon. Maybe they're not going to cut as much. So in January, the market was pricing in 6 interest rate cuts, probably starting, maybe as early as March, May. So the equity market sold off, the bond yields rose, which made prices go down. So kind of a repricing in the market of that new information on CPI. So now the market is pricing in about 4 cuts starting in June, and that's more aligned with what Vanguard believes. Our economists are thinking to be kind of the base case, maybe 4 cuts later in the year, second half of the year. I'll just add the January CPI reports are notoriously very volatile because a lot of contracts reprice at the end of the year. So, not taking too much concern into the January figures that inflation is going to skyrocket back up, but just a little underpinnings of the volatility that we saw this week and how the market tends to price that in. All right, so this is thinking about illustrating that really low period of interest rates that we've experienced, and then our forecast for where interest rates are going to end up in 2024, 2025. In the U.S., we're thinking about 3.5% would be that kind of neutral rate of interest after the cut cycle is done. The reasons behind kind of that higher level of interest, and our expectation that neutral rate is going to settle higher has a little bit to do with aging population, also that higher level of structural debt, government debt. When you have fewer savers and more borrowers, that sends yields up. So that's one of the factors and a way to explain why we think the higher neutral rate of interest going forward. And so policy rates are really restrictive right now, and that should dampen growth. That's one of the products of high interest rates. So that's what's shown in this dark blue bar. This is the impact on GDP that you would expect from the level of interest rates that we're seeing. If the Fed were to maintain interest rates at this level, that's what we should have seen. But we know the growth in the U.S. has been really strong. 2022, 1.9% GDP growth. 2023 was 2.5%. So strong growth. What is going on there? And there have been some offsetting factors in the U.S. that have really kept GDP growth going up. Part of that being if we're right that neutral rates are higher, that eats into some of that yield. But then also, consumers have benefited from a long period of low interest rates and locked in long-term fixed rate interest on their debt, and also really stimulative fiscal spending. We had the infrastructure bill, the CHIPS Act, the Inflation Reduction Act. That is the government putting a lot of money into the system, which also has kind of an offsetting factor. So while monetary policy might be very tight, fiscal policy has been very loose. So that has kind of led to this divergence in the impact that you would typically have on such restrictive interest rates, specifically within the U.S. I think that it's interesting, you look around the globe, where we have kind of high and restrictive interest rates across the board. We saw that eat into growth much more in the other parts of the world, the other developed economies. The Eurozone is teetering on a recession, maybe, in retrospect, may be in a recession right now. Governments around the globe have a much tighter fiscal policy. Their government spending hasn't been as stimulative. Also, particularly in Europe, they're much more bank-based financing, where in the US we do a lot more capital markets-based financing. So it's a much quicker flow through of monetary policy right into the economy. So that has had this impact of really dampening growth internationally, more so than what we've seen in the US. But we do expect, as those offsetting factors kind of work through the system and that long and variable lag in monetary policies for us to take in, we are going to see growth decline a bit in the US, and we'll get into that when we talk about forecasts. Let's kind of look at interest rates and what that means, and that, as I said, is very key. But there's a couple other points about what's going on right now that I want to make, and this is kind of coming back to our US large cap growth story. So the darker blue bar is showing US equity returns, and the lighter blue bar is showing non-US equity returns. And that's broken down by the performance of each sector for the year. And over on the right-hand side, I think that's what really pops out. This is like the 9 boxes by style and size, and kind of breaks up the market and how each of those portions of the market performed. And you really see that US large cap growth, outstanding returns relative to everyone else. And that was driven by the Magnificent Seven. Those are those 7 mega cap tech companies headquartered in the US that fall within these 3 sectors. That's, I have to look at this, make sure I don't miss one. Apple, Amazon, Google, Meta, Microsoft, NVIDIA, and Tesla. Those are the stocks that we kind of consider in there, and their performance has really been outstanding. So this dark blue bar at the top that ends at the top there is the total US stock market. If you were to strip out the returns of those 7 stocks, you end up with the performance of that light blue line there, which you see ends up right on top of where international markets perform. So it kind of shows you the impact of the performance of those 7 stocks over the course of the year and what that did to drive returns. So that's really how you're getting that really strong returns in U.S. large cap growth when you look at those charts about historical performance. And I think that this is really an interesting way to look at it. So this is the MSCI All Countries World Index. It's the investable market capitalization, your opportunity set across the globe to invest in. And then it's broken out by the percent each of these stocks is of the index. So for instance, Apple is 4.3% of the overall equity index. Then you think about the 5 countries underneath the United States. The US is 62% of the index. The next largest is Japan at 5.6%. But when you think of the size of these companies in relation to the size of the next 5 largest countries, you see the impact of like how enormous this company. Each of these are $2.8 trillion in market cap, enormous companies. But I do want to point out that this kind of performance and market concentration in a small number of stocks driving the market is not uncommon. We frequently have this, with the FANG stocks, the FANG, but even going back further, we have analysis that looks at the past 100 years of US equity market returns. And over that period of time, 50% of the returns were driven by just 72 stocks. Think of all the companies that have come in and out of the US equity market, 72 of them have driven half of those returns. So, market concentration in a small number of stocks is not uncommon and something we need to be fearful. It has driven valuations, and we'll talk about that when we look at kind of forward expectations. But I want you to think about this in context that these companies have done a lot of the work for us in the US, but that's not uncommon. So lastly is the presidential election. And what does that mean for markets? So this is kind of looking at election years and non-election years, going back and annualizing the returns. I'm not trying to diminish the importance of it because I think personally, for all of us from a policy perspective and just cadence of daily life, the presidential election is very important. But from a capital markets perspective, it doesn't matter. There's a million ways that I can slice and dice and show similar charts to this. The market looks through that. It's really, so to think about investing decisions around the presidential election and making decisions based on that, really the market from a return perspective and a volatility perspective, it tends to kind of look through that. And maybe that's kind of because it's like a known unknown, and those are not typically the events that rile markets. It's the unknown unknowns, the COVIDs, the global financial crises, the September 11th attacks. That's what tends to really create a lot of volatility in the portfolio and exposes your vulnerabilities within your portfolio. The famous Warren Buffett quote, when the tide goes out, you see you swimming naked. It's that volatile times that's going to really show you your risk. So how do you navigate that? And it first is building kind of a resilient, diversified portfolio. You don't want to be concentrated in any one area. You want to cover your asset classes. You also want to know what you hold and why you hold it, and that those underlying components behave the way you think that they will. There's a lot of opacity in the way we construct and package options to invest in nowadays, and really understanding what you hold and making sure that it behaves the way you want it to. And then working with a manager who is acutely focused on risk, like Vanguard. So, if you're doing those things, then everything else is just noise, and you're able to focus on the long term. So if you're thinking about what's driven the noise and what could create a lot of volatility, but thinking about not overreacting to some of the volatility and news headlines that you're going to see. All right, so the last section we'll move into is capital market expectations. So this first chart is kind of thinking about our forecasts with respect to GDP growth, unemployment, inflation, and then what monetary policy is going to look like. And I will admit that the first three don't look that dissimilar from what I showed you last year at this time. We're expecting growth below trend kind of across the globe. Inflation that's about, unemployment about 1% higher than it is right now across the board. And then, core inflation that's really eased quite considerably. These numbers are much lower than, the 3.9% core inflation that we've just recently posted. So really a lot of progress being made on inflation. And then loosening monetary policy conditions across the globe as well. So before we kind of think about what does that mean for returns for each asset class over the coming 10 years. There's a couple things that are kind of driving that, and all economic forecasters have an element of valuation in their forecasting models. Where prices dislocate from their fair value, they expectation of reversion to mean. So this kind of brings us back to what does that mean about the outperformance and valuation of some of the U.S. Stock market. And so I'm kind of focusing on our estimation of fair value and then where we currently see. So there's a lot of ways to create this blue line. Valuation is typically, it's a price of the security over some level of underlying intrinsic value of the company. So it could be earnings, it could be price to book value, sales. Frequently we use price to earnings ratio, and then this one is cyclically adjusted for the fluctuations over the course of the year. So what that's showing you is that U.S. valuations are really at a level that we haven't seen so high since the dot-com bubble. And that's not to say that we are in a bubble, but it is kind of giving you a perspective about what level of justified valuation are we at. And it's our expectation that we're going to have to see some type of reset in that. So that's not necessarily that the price is going to go down, but that underlying, the divisible, the denominator is going to have to increase, or one or the other, because we are really at elevated levels of valuation within the United States. We've also seen, but this isn't new, we've seen for 10 years, the US just handily outperformed international markets. It's been outperformance of US over international is 7.5% annualized over the past 10 years. So every year, on average, the US outperforms international markets by 7.5%. It's kind of disaggregating that outperformance in the US. What has driven that? So a little bit has been earnings growth, because we just have stronger earnings growth in the US. It's kind of offset by dividends are higher internationally. So that's been a small component of it, but the main part of that outperformance in the US has been valuation expansion, so paying more for every unit of earnings or sales or book value, and then also currency effect. So thinking about the valuation expansion, we're at a very high level. We are unlikely to see that level of valuation expansion continue over the next decade. And the same kind of goes for the currency. This is the US dollar relative to fair value. We know that the US dollar has been very strong. A decade ago, we were at a similar level of undervaluation, and that led to a decade of really strong returns for the US dollar. What that does is dampens the returns of international stocks. And conversely, when the US dollar weakens, that increases the returns on international prices. So we're thinking that some of the tailwinds for the US dollar are likely to dissipate. Maybe not necessarily become headwinds, but I don't think that we're going to see the same level of outperformance of the US dollar continue for the full next decade. So there have been some supports, and currency is an interesting thing because it's hard to predict. There's a lot of volatility in there, but it is more of a mean reverting. It has more mean reverting characteristics than, say, valuations do more quickly because of the Big Mac principle. If you buy a Big Mac in different currencies in different countries, they're going to work their way down to be around the same. So what we're thinking is, U.S. dollar is highly overvalued right now, and that will likely come down, which might support your international valuation. So those are a couple factors that are going to play into what I'm showing here, which is these are our 10-year annualized forecasts for all of these various asset classes. On the left-hand side, these are risk, your return-generating components of your portfolio, your equities. And you see here U.S. equities, and then maybe down here global equities ex-U.S. And I think that's the comparison. So we took the median value of what our calculation is, and then put kind of 1% band around that. So our expectations are for U.S. equities as a broad asset class to return about 5.2% per year. International equities, are much higher at about 8%. So it gives you a visualization of if these revaluation currency impacts come into play, what the relative disparity between U.S. equities and international equities is. And then in fixed income, when we were sitting at 0 rates, those numbers looked more like 1.5%. Now we're showing, U.S. aggregate bonds at about 5% expected return. So what that means is you're now clipping a coupon on your stable risk mitigating portion of your assets, where before they were sitting there not earning anything or very little, but still meant to be your volatility dampener. That's still the role in the portfolio because you see on kind of that volatility column, there's not a lot of volatility. They're kind of capitated how high they're going to go and how low they're going to go. Where your equities have that wider range of opportunity set, but that is really where your growth occurs. So, guarding against from saying, well, I can get as much in aggregate bonds as I can from what you're expecting in the U.S. equity market, but the range of outcomes over time is quite different. So I like to think about the fixed income and the reasons that you hold the things on the right is really to be your volatility dampening portion of your portfolio. But what you're getting now that you haven't gotten for quite a long time is an ability to earn some income off of that. These are forward-looking return expectations, and maybe let's talk about it. What questions do you have?
Talk about equities being overvalued compared to the past. And even if you take out the Magnificent Seven, you still arrive at that same conclusion. Not as much.
Not as much, right.
But I believe you also used the term reset in your presentation. And I'm wondering if that suggests different allocation. For instance, the organization I represent, we're at 80-20. Your historical look there was 60-40 or 70-30, I think, when the earlier chart.
Right.
Do you, as a global recommendation, think it's time to take a look at any rebalancing?
So I'll take that, I'm going to answer it in 2 parts. First part is what does that mean for your equity component of your portfolio?
Yeah.
And that is where I am looking at clients' portfolios and thinking about your allocation between U.S. and international. Right now, historically, there was about 50% of the market was U.S., 50% was international. That has, as U.S. is appreciated, that's now 62%. U.S. makes up 62% of the investment market. So if you're going to market capitalization weighted, you have about 60% of your equities in the U.S. and 40% international. There are many clients that I have that just are much more biased to the U.S. Maybe don't hold international stocks or hold much, much smaller allocation to international stocks. And this is a time to reevaluate kind of that portion of your portfolio and thinking about, hasn't come to pass for the past decade, and I don't know that next year I'm going to be sitting here talking to you about really strong outperformance in international over U.S. But thinking about over the long run, how do you best position your portfolio for success? And I think considering your balance between domestic and international is an important time to do that. Your overall balance between equity and fixed income, that has to be goals oriented and a long-term focus. That is by far your biggest driver of long-term return. By far. It's going to be how much do you put in equities and how much do you put in fixed income. And I am a very large proponent. If you have a long time horizon, you don't need to continue to pull from those assets, and you're able to kind of just be patient and withstand the volatility that you will exhibit, that the equity portion of your portfolio will exhibit. Having that higher allocation to equities is what is going to get you to your highest return potential over time. So still thinking in that long-term scenario for clients who have maybe a much lower risk tolerance, shorter time horizon, less tolerance for volatility, what they're getting now from that fixed income component is a yield that they didn't have before. But reevaluating kind of that overall balance, I don't think if your time horizon and your goals and your need for those dollars hasn't changed, then I think the overall asset allocation still remains very prudent.
I won't throw that 25, 25, 25. I'll let that one go.
We're going to talk about commodities.
First of all,
Excellent presentation, thank you. And after 2022, when fixed income went down, equities went down, there was commentators, definitely a lot of commentators who were saying that the balanced portfolio, the 60-40 portfolio is dead. Now, with fixed income interest rates higher and stabilized, and now expected to be higher for longer, and so is that back into, it seems like it's definitely back into favor.
We, our fixed income team, they say 60-40 is back, bonds are back. And so what does that mean, And I think if we were running kind of a simulation of what you might be able to return over 10 years from a 60-40 portfolio 3 years ago, you weren't going to get to 5% real. You just weren't. So that's where we say, the 60-40 was dead. It was, if you're trying to draw 5% off of your portfolio, it's going to be really hard to get there. So that kind of either takes you to diminish your fixed income and put more equities in there, or reach further in your equities into the risk spectrum. So what the difference is now is that you are getting a significant yield off of that fixed income. So your overall level, what that risk-free rate does is it kind of pushes up all of those assets. I think the equity risk premium is probably a little lower, but you're able to get a more kind of sustainable, higher level off of that 40% of your portfolio that you have for many years. So when we say 60-40 isn't dead, I think that's probably has a lot to do with how much more you're getting off of your fixed income.
More questions?
Thank you.
Thank you.
So business update, as I mentioned, think back to 2009, we began with Vanguard. They became our manager for our fixed income and ran all of our fixed income. In 2013, they took on all of our equity, and we were all in with Vanguard as our advisor. And that's in the form of OCIO services, outsourced OCIO services. Anybody familiar with what OCIO is? Outsourced Chief Investment Officer. So they are our outsourced Chief Investment Officer. And so they've been doing that for 15 plus years. Back in December, one morning, I got a text from Jerry and said, you gonna be around a little before 1 o'clock? And I thought, well, that's odd. I texted him back, said, sure. He said, I'm gonna call you a little before 1. And so he called me right before 1 and said, just wanna let you know I'm getting ready to go to a meeting. They're gonna make an announcement that Vanguard is selling its OCIO services to Mercer. And so, and sure enough, the announcement happened. I don't know if any of you have seen, I know Dick has seen the announcement. And those services have been purchased by Mercer, and they're going to become official mid-March, I think you said. And so, of course, this was in December, and that led to a lot of conversations between us and I still refer to them as Vanguard right now, with Jerry and Becky, and where are things going and what did they know. And we've met periodically as they've learned more about the direction of things and where things are headed. And then I've also talked with representatives from Mercer as well, from their point of view, and they certainly seem to want the business. And so the transaction, as it is, I told someone before we met it, so Vanguard has $8 trillion in assets, I think. Is that correct? Small number, but they sold their business, and when you're considering $8 trillion, you think, okay, they sold this business, it's their OCIO services, and it's a significant number, and it is, but yet it's not. But they have sold their business, and it really amounted to about 1,000 clients and about $60 billion in assets that are moving over to under Mercer's umbrella. It also included 120 employees from Vanguard. So Vanguard in Malvern, we go up there almost every year and meet with them once a year. So Mercer is leasing or buying a building in Malvern, and these employees are moving out of Vanguard and into a Mercer building, but things are going to stay the same as they appear to be. And so just wanted to bring that to your attention. I'm going to let Jerry share a few comments on that. Britt will speak a little bit about where we're headed as we evaluate that. But our understanding is nothing will change. Our agreements with them will continue, and we will proceed along, and of course do our due diligence and keep an eye on things as they go forward. So I'm going to let Jerry share just a couple of slides that are in the book, and then we'll all take questions from you regarding it.
Sounds good. Oh, long way, Corrigan. We've been working together for a long time, so I wanted to make sure Todd had a heads up before that announcement came out. So a couple things I want to talk about. First of all, I want to say thank you for being a client for such a long time. Most of the people in here know you're my favorite client, and so I love coming down here. Why did this happen? A lot of folks ask us that. What's going to change? What's not going to change? What's the future going to look like? Why did Mercer want to buy this business from Vanguard, and Mercer approached Vanguard? They do a lot of advisory work for institutions at Mercer. The vast majority of it is with pension plans, corporate pension plans and public pension plans. They wanted to do more in the area of nonprofit advisory services. We're larger than Mercer is in nonprofit. Our $60 billion compares to about $17 billion for them. So they like the way that we do it. They understand that we do it well at scale. We have great clients, so we have great people. That's why they wanted all of us to come over. And almost all of the 120 are coming over. There's Carol and somebody else retired. There's a small handful who aren't going to go. Everybody who's related to the EverBless Foundation portfolio is going to go. Relationship is going to go. So they really were interested in this business. Why did Vanguard want to sell it? Again, we're $60 billion seems like a lot, but when you're an $8 trillion organization, it's a relatively smaller piece. Vanguard is literally tripling down, serving the individual investor, whether that's directly in a retail account, through a plan sponsor 401k provider, or through an investment advisor, an RIA. We're still Vanguard, putting all of our efforts into that. So it's an unusual thing. It's the first business that Vanguard's ever sold, but that's why Vanguard was willing to part with it. That's why Mercer wants to buy it. First thing I asked when they told me about this, I had to sign a non-disclosure agreement because Mercer's parent company is publicly traded, Marsh McLellan. First question I asked is, I said, our clients are going to want to know, am I going to work with the same people? What's my portfolio going to look like? What are my fees going to look like? Mercer has committed to same team, same portfolio, same fees. And we've gone back to them over and over the last 6 months to continue to ask. Our clients ask directly. I'm sure Todd asked when he talked to them. All that's going to stay the same. They have no interest in changing any of that. So I hope that makes y'all feel good. The other thing is personally for myself and my team, again, we've been working together for 15 years. There's a lot that happens in one's life over 15 years, and EverBless, formerly Virginia Baptist Foundation, has been like a constant in my life. We have 3 kids. The oldest was 8 years old when we started working with Virginia Baptist. She's out of college now. The other 2 are in college. So what I want to tell you, I'm going to Mercer. I'm going to be running this territory still. But my commitment is that to you is that don't tell anybody else, but EverBless continues to be my favorite client. And once we get over to Mercer, I'm just got to make sure that everything continues to work the way it should. But I really wanted to answer any questions you might have about this.
Can you describe a little better Mercer? I'll go back far enough. I remember them in the pension business in a big way, and didn't realize they had such a large investment arm. But maybe anything that sets them apart from Vanguard, sets them apart from the industry as a whole. What are their strengths, weaknesses, and how do you see them thus far?
Sure, so the major business line for Mercer is still pension. It's pension, it's advising on 401k plans, and it's advising institutional investors like nonprofits. That's really mainly the three. They do some work with large insurance companies too, insurance general accounts. One of the benefits to our clients and to us going to Mercer is they're much more institutionally focused than we are. They don't do any retail. So where a lot of what we brought to this group in terms of the portfolio or in terms of research has been really good and solid, but it's really, we're at the heart, we're a retail organization at Vanguard, and a lot of it kind of ports over to institutional, so it's worked and it's been good. But what we're going to see here going forward is more institutionally focused materials, conferences, thought leadership, and the like. So we're going to see that. That's going to be the biggest difference.
Sounds good.
Okay.
Vanguard's big advantage is that its corporate structure is owned by shareholders. So, you mentioned about fees, with Mercer being a for-profit business.
Mm-hmm.
It seems, 3, 5, 10 years that there's a greater likelihood that the fees might go up because it's a different corporate structure. Can you talk about that?
That's exactly what I asked. So a little inside baseball. Our corporate.
Repeat the question.
Vanguard's known to be the low-cost provider. The reason for that isn't necessarily because we're an indexer. It's because the Vanguard funds are owned by the Vanguard investors, all right? And the Vanguard funds themselves own the Vanguard management company, and everything operates at cost for the benefit of our shareholders. That's why our index funds are low cost. That's why our active funds are low cost. And the question is, how are you going to keep the fees the same at Mercer if that's the case? From a product perspective, it works exactly like we're talking about, and our funds operate at cost for the benefit of our shareholders. On the services part of Vanguard, whether it's full service record keeping, whether it's advice to EverBless, that's not delivered at cost. That's delivered at some sort of a margin that is able to be reinvested in the business. That is the margin that we are earning, which isn't a large one, but it's big enough for Mercer. We've been through that math with them, and that's why they said we don't need to raise rates for us on the advisory fee. And because we're able to, and we ask this question, can our clients still own all Vanguard funds if they want to? The answer is that question is yes. So the at-cost nature of the funds in the portfolio will always stay the same. The other dirty little secret is we're not even a low-cost provider in indexing anymore. Fidelity's cheaper than us. Yes.
My question is, what's the term of this agreement in terms of having done some of these in my previous life? There's a propensity on the part of the acquired company to change sooner than you expected in terms of how the original agreement was solidified. Is there a term to this, like is it 5 years, or there's no term in terms of this initial agreement that are signed?
What I'm learning is a lot of the board members of our different clients have more experience with this type of thing than I do, because several people have said the same thing to me. In terms of the terms for the employees, we're incented to be there over at least a 3-year period in terms of retention and the like. We've asked a lot of questions about, is there going to be attrition? You're going to want to start to reduce headcount or anything like that. And they keep saying, no. As a matter of fact, what they check in with us most often about, they're very interested in our clients consenting to go over to Mercer. Very interested in that. What they're more interested in is like, how's the crew feeling? Out of that 120, how many are we going to get? So they're very, very keenly focused on making sure we all go over there and keep running this business. I don't see, the other big difference between where we're going and where we are is nonprofit OCIO is one of the main growth initiatives of Mercer. Mercer writ large. At Vanguard, it was great and it worked, but we took what we could get. They're going to invest in this business, it's going to grow. There'd be no reason for them to do this if they're going to start to marginalize it or reduce it.
Okay, thank you.
Time will tell, but I'm optimistic.
From our perspective, our agreement with Vanguard that's continuing on with Mercer is through October of 2026. And so they have agreed to honor that, so any change would occur beyond that from our perspective.
I know that in industry, when I was thinking, the minimum term typically is like 5 years. So we're really a very part to not change the terms. So it's important that we understand the terms that they say one thing,
Right.
Right.
but then they may do it different if it's not what they.
And I say our agreement is with them through October in terms of the fee structure and what have you. We have the ability to leave earlier if you prefer.
I think when Mercer, we're still two separate companies, Vanguard and Mercer, we need to operate separately, so there's like antitrust, but I believe that Mercer talked to you and confirmed to you that
Yeah.
things are going to stay the same.
Yes, it's been, I talked to Jerry, I don't have the answer to that, I can't answer that, and I have to call Mercer or talk with Mercer and get it from their side. But yes, that they have.
There, I think.
Sorry.
Two questions.
Sure, yeah.
What are the net fees for, let's say, the balanced portfolio? And how can we get to see what's actually held in that portfolio?
Well, we don't, in terms of what is actually held in the portfolio, we do have a top 10 metrics that we can provide from a standpoint of that. We can produce a full detailed report, but it would be.
At the holdings
Regularly.
level,
Yeah.
yeah, but we could also, at the fund level too, if that would,
Yeah, you can do it that way too. But we can produce that for you if you would like to get that. And then the fee, I'm not sure exactly, depends on your mix and what have you, but if you're 100% in the balanced, you should be paying right around 74, 75 points.
goes to those funds. Todd.
Any other questions?
I'll be around after.
Yeah, he's gonna hang around after a little bit. There's still food over to help yourself. Just, I guess to wrap up, thank everyone for coming. And I want to recognize the team here. Cindy Strain is here if you would wave. Wendy Reynolds in the back. Janet Bess. And then Preston Jones. And Preston is our newest employee. Preston started last June. He's our new CFO. He was with Kiter CPAs beforehand. He actually audited us for 6 years prior to coming on board.
And he still came on board?
And still came on board. So we're happy to have him. Our swag table is over here. Please help yourself as you head out. Grab a coffee mug, umbrella, magazine, what have you, free to you. And that's it. I would ask if everyone would stand, and Rob, would you close us with prayer, if you would?
Why we pray. Gracious God, our Father, we thank you for this gathering. We thank you, Lord, for how you have guided us through this process. We pray now for continued success of EverBless Foundation as we work with our partners. Lord, we love you, we praise you, we magnify you. It is in the name of Christ we pray and we give thanks. And everybody say it. Amen. Amen.